Welcome everyone, and thank you for joining us this afternoon for our year-end tax planning session. Jude and I will be tag teaming and presenting things that you sort of need to know about, and no doubt between all the partners at BDH Leaders, we'll be in touch with all clients anyway to talk about year-end tax issues between now and 30 June. What we want to cover off today, obviously, there's some serious changes that have been thrown at us by the tax office, and that happened a couple of months ago. We're obviously going to be talking about things that you need to sort of look at when dealing with tax planning and year-end reminders. Can I ask that, and then we'll have a Q&A session at the end. What I would like to do is, if people have particular questions that they would like answered by us, can you, rather than jumping in during the presentation, can you maybe just send a chat on your screen, and Jude or I will deal with it either at the end or during the course of the presentation. So let's get into it. As I said earlier on, the biggest thing that's happened this year has been the tax office's attack on trusts. Earlier this year, and when I say earlier, we're talking about February, March, the tax office issued a practice note on how they see trusts working, and sorry guys, can I ask that your microphones are turned off? The tax office issued practice note that basically...
IQ. Do you have the LNSP number?
Hello, can I have microphones please turned off? Sorry, as I was saying, the tax office issued a practice note that basically talked about how trusts and how they saw trusts being taxed. And so what this does is it puts, obviously, the beneficiaries of trusts at sight of the tax office. The tax office have turned around and said, hey, we've got white zones, we've got greens, we've got blue zones, we've got red zones, whatever we've got, and you fit into a particular zone, and they assess the risk based on that. And I'll talk about who was impacted and what we sort of need to do. Now, the tax office, where they're going to with this, it revolves around this section 100A. And what section 100A basically, what this is all about is the tax office is basically saying, okay, if on paper you decide to make a distribution of $100 to a beneficiary of the trust, they want to see that money actually paid to that beneficiary. So what they're wanting to see, what generally tends to happen with tax planning and stuff like that is, as advisors, we would normally turn around and say, hey, have you got kids that are over 18, can we distribute to them? But it's actually, in fact, the parents that keep the money. What they want to see now is that you are actually paying, if you're going to make a distribution to a child or distribution to a parent or anyone that is probably in a tax favourable position, they want to actually see the cash going to that person. Okay? Historically, that really hasn't happened. But with note that came out at the beginning of the year, they have turned around and said, this is what we want to do. As I said before, they've created all these different coloured zones, and I'm not making this up. So they basically said anything before 2014, we're not really going to look at, we're not going to touch. Okay? So this not only looks at distributions that we make from this year going forward, but it also considers what historically has happened from the 2015 financial year to now. Okay? So then they look at, they put you in the green zone if obviously you've made a distribution on paper of $100 and you physically paid that distribution to a beneficiary, then they're not really going to have a look at you. Then you've got this blue zone that basically looks at it and says, look, we might review you, because you're not fitting into a red zone, green zone, or a white zone. And then you've got the red zone, which basically looks at situations where money has not flowed to the person, the beneficiary. Okay, so you've paid a distribution to an adult child, and the money has, the physical money has actually stayed with the parents. In those situations, the tax office is likely to tax the trustee at the highest marginal rate of tax. Now, this is a major, like I said, it is absolutely a massive change in respect of how trusts are being distributed, how trusts are going to be dealt with. And it's interesting that this has been issued just before a federal election. If the Liberal governments stay in, I think we're probably going to have industry bodies like the Institute of Chartered Accountants and stuff like that have actually taken exception to this and are lobbying against it. It'll be interesting to see what happens come the end of May, and whether or not we've got a change in government and what they do in relation to this. All we can do now, between now and 30 June, is basically take heed of this practice note and make sure that if we're going to distribute to an adult child, that the funds go to the child, or go to the parent, or go to the beneficiary. And what we need to do is obviously have appropriate documentation in place, things like trust minutes, things like bank statements that evidence the flow of funds. So all those sorts of things are going to be important to make sure that whilst this is still in discussion phase and all that sort of stuff, it's important that we sort of try to get this right now, this financial year, because the tax office will actually start looking at it. Certainly they've indicated from FY15, but this financial year to start with. Budget announcements, nothing really happened in the budget except for superannuation. I think G's going to talk more about superannuation later on, but the minimum superannuation payment on those that are in pension phase has been reduced to 50% of what it would normally be, and that's been extended to FY23. Gede, I'll get you to talk about Division 7A, which is always a topical and an interesting thing that we've, as accountants, have to deal with.
Yeah, thanks, Tess. So yeah, welcome everybody. I'll try and go through quickly because we haven't got a lot of time. But if you've got any questions that come up, feel free to include them in the chat. I'll have a quick look at there and see if there's something I'm not covering, or if you want to speak to your contact at BDH Leaders, we can definitely take that on board and answer that. So you see on the slides, we're talking about new rules, and this is really new rules from last year. Now, it's actually going back to 17 that the government put in some announcements in the budget, and they extended them forward. They were going to start in 1920, and then we had COVID, and a lot of things got deferred. And some of these are around little fixes that, so some of them are little technical things that they're going to fix with Division 7A. Now, what I'll do is I'll just briefly explain what Division 7A is for people who may not understand it. So Division 7A basically covers private company loans, essentially to shareholders and directors who are usually shareholders, quite often in most private companies. And so it's where you have a loan outstanding at the end of the financial year and it hasn't been repaid. So the tax office, we have laws in place and rules that requires those loans to be repaid or to be put on a loan agreement, and the ATO sets the interest and principal repayments generally over 7 years, and in some limited circumstances you can extend it to 25 years. So what we need to do is identify what are current year loans and see what are we going to do about them this year, and make sure that that we're looking at those and knowing what the impact's going to be. The action needed to be taken by company's lodgement date. Generally, if a loan was outstanding at the previous year, and it's repaid before the lodgement date of the tax return, then it bypasses Division 7A and won't be a Division 7A loan. So in relation to this, we also need to identify last year's loans and prior year loans and see that they have been put on under complying agreements, and also that minimum repayments have been made. So as I said, generally they're 7 years with interest. In some cases you might have a 25 where you've got security, but we need to look at those and see have they been paid. Given COVID as well, there are some very limited circumstances where you can apply to the ATO where you haven't met those minimum, and they can be rectified, but generally you have to notify the ATO for that. Integrity rules in section 109R. So what these basically, just very briefly, is there are integrity rules where people just try to refinance previous year loans and roll them over to new loans. So all those are basically in place. So if you want to move on to the next slide. So some of the things that people might do where they don't physically pay the loan, they might actually issue a dividend in lieu of a loan. What we've got to be just wary of is where we are doing this, there's things what they call like a set-off arrangement. And this is where we're offsetting the outstanding loan with a dividend that's been declared. So you'll see in the boxes there's a few things that we just need to consider. So does the company constitution allow it to be offset? Is the borrower an actual shareholder of the company? Any evidence that the dividend's being declared? So we're looking at minutes and documentation that's normally done. Is there any evidence of the parties agreeing to the set-off of that dividend against that loan? And just going into the accounting records and see what was actually done from an accounting perspective as well. So this is basically an example, and this is where we got a Gertrude who's been lent $50,000 from her private company, ABC Proprietary Limited, and she's a director and shareholder of the company. Now, the accounting records that have been produced and prepared show that there was a $50,000 director fee, and that was applied against the loan just before the lodgement date. So say 15th of May for a loan that was outstanding at 30 June previous year. Now, this was to bring the company loan down to nil and then hopefully avoid Division 7A. So the question there is posed is, are there any problems with this? Well, obviously it raises a few number of issues. As we mentioned previously, does the Constitution allow it? There's pay-as-you-go withholding obligations. So like an employee, a director is generally an employee of the company. Have we withheld, wages tax and PAYG? And then there can be tax ramifications for the actual payment of that dividend or declaring that dividend if we haven't withheld those pay-as-you-go. Is it actually satisfied? SG, superannuation guarantee. So this year 10%, next year it's going up. Have we, has superannuation been paid or considered in relation to that? And then just evidence, as we mentioned previously, that the parties did agree for the set-off for those fees, and how was it actually recorded in the accounting records? So as you can see, Division 7A is sort of it can be a very complicated area, and something that, if you are borrowing money from a company, from your private company, and you are using it for, for other purposes outside of the company, we really need to look at these issues and make sure that, loan documentation, right of offsets, and the right policies and procedures and documentation is all put in place.
And I suppose in addition to what Jeet's saying there, the minimum payments are actually met because that is absolutely critical to making sure you don't fall foul of Division 7A.
Yeah.
And it's also important having regard to what's going on with the tax rates. Obviously, what we have is a situation where tax rates are actually falling. This financial year, we're coming in at a tax rate at about 25% for companies. So if you decide to pay a dividend out of the company, you're obviously going to have a lower franking credit than you would in this particular financial year than you did in the FY21 year. Okay, so going forward, 25% tax on company profits starting the FY22 year. Now, That's a great thing because obviously lower tax means more cash left over, more money to reinvest in the company. You have a situation where you're going to have, because of this, a lot of franking credits trapped in the company that you may or may not be able to use. I mean, you've gone down from a rate of 30% to 28 to 27 to 26 to 25. So that all means you've got excess franking credits in the company. And the other issue is obviously when you're paying out a dividend to shareholders, whether it be because you've got to deal with Division 7A or whether you want to take money out of the company and pay tax on it, you're going to pay the gap tax. And that's going to be the tax rate between the highest, whatever marginal tax rate you're in. And the highest is going to be 47%. And you're obviously getting a tax credit from the company on this dividend at 25%. So that gap tax is going to be at a rate of around 22%. Okay. Anything? There's nothing else I want to that's for companies that turn over less than 50 million. Obviously, if you're a shareholder that receives a dividend from one of the banks and stuff like that, your franking credit is 30%, and companies that are turning over more than 50 million, small businesses, or they're not small businesses, they're large businesses, get taxed at 30%. And so you'll still get your franking credits at that 30% rate. In addition to that, it might be from a tax planning point of view. I mean, there's not much in taking a dividend now versus taking a dividend next financial year because I mean we're talking 26 versus 25%. So is it a benefit? I think it is. Obviously, if you want to retain the cash in the company, obviously paying off debt and allowing you to have additional working capital in the business so that you can fund expansion or growth or anything like that you want to do. G, do you want to talk about trusts?
Yeah. So just further to what Tass was saying, companies that aren't considered what they call a business entity, so passive investors, will still be paying that 30% tax rate and have 30% franking credits as well. So it's sort of, we need to identify, are you running a business as opposed to being a passive business or passive company. Now, trust distributions. So what we've got here is just some checklist of things that we generally need to look at. Now, trust distributions generally, and as we'll see on sort of a later slide, need to be sort of done prior to the end of the financial year. Generally, most trust deeds, all trust deeds generally require that, and the ATO requires that they at least be determined and preferably documented in writing because that's actual evidence that they actually have been considered and determined. So what we need to look at is what is the definition of income in the trust deed. So different trust deeds may have different definitions as to income. So we need to look at that. What is the income? Do we have different beneficiaries, which is income and capital beneficiaries? And this can be, different types. There can be different types of trusts, fixed trusts and discretionary trusts. FTEs and IEEs, what they stand for is family trust elections and inter-entity elections. So these are some elections that either have already been put in place or do we need to put them in place because do we have any new beneficiaries that we might want to be including in our trust distribution? What is a requirement for fixed trusts? So they're generally a unit trust, which a lot of people might run their business or service entity through or own property in. Streaming, what this is talking about is where we might be sending income, which may be a dividend or profits to one beneficiary and sending a capital gain to another beneficiary because there may be some tax advantages in relation to doing that. And also just be very mindful of the trust vesting date because generally trusts will last for 60 to 80 years depending on when the trust is set up. Now, okay, for obviously trusts that have been set up recently, that's not an issue. But if there's been a trust that's passed down to a couple of generations, it's very, very important to look at that and see that the trust has invested, which means, is it required to essentially be wound up, and obviously the assets and liabilities of the trust had to be dealt with. So, as I said on the previous slide, is the timing issue for distributions. Essentially, we need to make the decision. So we need to look at the beneficiaries, see who they are, who's eligible, and make the decision on which beneficiaries are going to receive a distribution. And then we need to record the decision. And all these need to be done by the 30th of June for that current financial year that you're dealing with. Now, next we've got trust reporting. So another thing to take into consideration is that if anyone is distributing to tax exempt entities, so they could be, very, very generally they could be, some not-for-profits or other things. We need to make sure that that these are paid and notified within 2 months at the end of the year. And there are some integrity rules dealing with, similar to what Tass was talking about before, where the distribution doesn't really match, where the right person and where the funds and cash have been distributed to. Another thing we need to take into account is tax file numbers for beneficiaries. There is what they call a trustee beneficiary reporting, and generally we need to report to the ATO before the trust tax return is lodged. We need to notify the ATO of potential beneficiary or actual beneficiaries that have been decided upon, and we need to let the ATO know. And this is obviously for them to do their data matching, so they will then follow that trust distribution through to the individual or that they expect that to happen to. Also, other thing to be wary of is watch out for minors, non-residents, because the tax rates can be different. There could be trusts that are required, or trustee is required to actually pay the tax or withhold tax before these type of beneficiaries. So if any of these beneficiaries are eligible under the trust, we just got to be careful that they could be subject to penalty taxes and also withholding taxes, and be mindful of new trusts for these reporting rules that have come in as well. So
that all that content's pretty heavy. So let's just take a bit of a break and talk about some of the more traditional things that we need to sort of look at when we're dealing with year-end tax planning. One of the biggest issues that we have as accountants is depreciation and stuff like that, looking at your balance sheet and determining actually whether you do have that old computer or the filing cabinets or whatever. It's probably not a bad idea that we have a look at the assets that are sitting on your register and work out whether or not we write them off and claim the tax deduction this particular financial year, rather than letting them depreciate at 10, 15 or 20% of their written down value. So it's certainly something that should be looked at before 30 June. For those of you, and this is obviously those that run pharmacies and stuff like that, trading stock is an important thing. Because the value of your closing stock as compared to the value of your opening stock has an impact on your profit. Where your closing stock is greater than your opening stock, that increases your profit, and where your closing stock is less than your opening stock, that creates a bit of a loss. So it's important to look at what stock is obsolete in your stock take. Obviously, you'll be doing it between now and 30 June. Closer to 30 June, and work out what stock can be written off. Obviously, for those we've got a few clients that are share traders, and you can change for those. For example, you can actually look at the valuation methodology that you use in determining what the value of what you're holding is. So, for those of you, for example, just to give you an example, if a share trader buys a share in Westpac at $30 and at 30 June the value of that's 25, we can take up a value of 25 as opposed to what the $30 that share trader paid for it. So sometimes it's useful to sort of go through your stock take and determine whether or not the value of the items that are sitting on that list are actually less than what you paid for them and adjusting for that. Bad debts, obviously, if you're carrying debtors, if you've got debtors on your books and people are not paying you, and they haven't paid you by 30 June, and then unlikely to, then obviously writing them off by 30 June can help reduce your tax burden as well. Prepayments. Now, prepayments went probably a long time ago, but where you run a small business, okay, you can actually enter into prepayments. And obviously individuals, those especially that hold rental properties or margin lending facilities against share portfolios, those sorts of individuals and small businesses can enter into prepayment arrangements whereby they can pay next year's interest, or they can, a small business can pay next year's rent. So they're things that you can sort of look at. Obviously, what that means is you're bringing that deduction forward into this financial year, which means you're not going to have that next year. And it's obviously going to be a cash imposition on the business too. So if you're going to be prepaying interest or prepaying your rent, you're going to have to physically make that cash payment before 30 June. Some of the more traditional things in terms of year-end tax planning is deferring income. Obviously, if there is a way that you can not invoice someone until the 1st of July, then do so. Wait till the 1st of July. Obviously, look at the commercial. Look, when you're dealing with this, I always say to clients, don't do anything for a tax reason. I mean, if you're concerned about someone paying, then invoice them straight away and receive the money. You're better off paying 25% tax or whatever your structure says that you do than not receiving anything at all. Look at your work in progress. If you can leave that sitting there and not bill it until the next financial year, that's fantastic. One thing that's also happened is that there's been a temporary expensing, a temporary extension on these asset write-offs. So between now and 30 June 2023, if you purchase an asset, you can actually effectively claim a tax deduction for that entire asset rather than having to deal with depreciation over the life of that asset. Other things, directors' fees, bonuses, all that sort of stuff. This all stems from a Merrill Lynch case, where Merrill Lynch, obviously the financial services institution, was paying bonuses to some of their dealers, and they were actually committed to making a payment. They could quantify the amount. And so they actually had a true liability, but they made the payment in the subsequent financial year. So that set up a precedent, and that's what this is all about. So what you can actually do is, if you can quantify a bonus that you need to make, you're actually committed to it, you can accrue that and take the deduction in your business this financial year and pay it to the employee in the next financial year. But obviously, you've got to deal with the PAYG requirements and the superannuation guarantee obligations as well.
Okay. We're getting close on time, right on time. So what I'll do is I'll quickly go through this. So in addition to the other deductions, there's superannuation. So as with prepayments and as with a lot of other things Tass was talking about, the deduction can be claimed when it's actually made. And you need to be careful that these actually have to be received by the super fund. So where you have a self-managed superannuation fund, then generally that's fine. You can do it up to 30th of June. If you're paying to an industry fund, sometimes they close the books a week before or 2 weeks before. So you need to be checking with them when they're likely to be processing that superannuation contribution. And also just be mindful that you also need to adhere to the quarterly lodgement due dates in relation to superannuation guarantee as well. Items that are subject to non-resident withholding tax. So if there's no actual deduction unless you've actually done the withholding. So you've met all your withholding tax obligations in relation to that. So you need to make sure that you do that as well. And also just be aware of, where you're accruing and capitalising interest and not actually paying that. You may not get the deduction for it unless you actually make those actual payments. Taxable payments reporting, I'll just quickly mention. So those industries that are listed, and they're mainly around the building and construction and contracting industries, are required to, in the last couple of years, they've basically been required to report all the contractors essentially and subcontractors they pay and their ABNs. Another data matching exercise for the ATO. So they just want to follow through and see, well, these people have issued invoices or have been paid by these industries, and they expect them to obviously remit their income. Just bear in mind that these reports are due by the 28th of August 2022 for the 30 June 22 year. A couple of reminders before 30 June. So this is just like a quick summary, some of them we've talked about and Tass has talked about. So in relation to self-managed super funds, making sure you pay your minimum pensions before 30 June 22. Very, very important that particularly pensions must be paid in cash. That they are paid. Now we've had a 50% reduction this year and next year, so there's obviously less that needs to be paid, but make sure that they're actually physically paid to make sure that the fund gets its zero or concessional tax each year. Contributions, as I briefly mentioned before, they must be made by 30 June 2022. Another thing to consider is where you've got a superannuation balance of less than 500,000, you may be eligible for what they call catch-up contributions. This can be very beneficial if you've got a large capital gain or a large income in one particular year and you expect the next year to be less. If you haven't met your 25,000 caps or 27,500 from this year, you can, in certain instances, catch up and get a tax deduction for increased contributions for the year. And lastly, just a reminder from the 1st of July 2022, superannuation guarantee rate is increasing. So we've got this gradual increase up to 12.5% over a number of years, which has been legislated now. So whichever party gets into government, they'll have to change the laws if that's going to change. That's also in place. So where most people have got software now, make sure that that's updated and that you are paying it, and be very careful on the timing of it. So obviously it's when you pay your wages that 10.5% will be applicable. So if you're paying wages in this year, it'll still be at 10%. If you're paying wages from next year, it'll be 10.5%. So just be careful, and the software you have should automatically fix that up. Just a reminder, sorry.
I was going to say, Gene, just as a practical thing in relation to those that employ people on packages where that's inclusive of the superannuation, what will happen from the 1st of July is their take-home pay will obviously reduce by 0.5% because you're going to be required to pay an additional 0.5% to super. Sorry, Jude.
Yeah, that's right. Yeah, so you have a look at employment agreements and contracts that you've got in place. Obviously, anyone who's paid their wage plus super, it's an additional payment. But as Tass said, if there's if it's a matter of a package, salary package, then their take-home pay will actually reduce. And just lastly, the indexation of contribution caps. So for this financial year and next financial year, the tax deductible amount that you can claim, or that's what they call concessional contributions, is 27,500, and the non-concessional is 110,000. Now, remember that if you are also employed by your own company or somebody else and you want to make a personal tax deductible contribution, which you can, just make sure that you don't exceed those caps. So you'll need to find out how much has already been contributed or likely to be contributed by 30th of June. So you can deduct that amount from that cap to see how much extra you've got available if you want to do that. And as we discussed before, very, very, very important that they are received by the super fund. And where you've got self-managed super funds, there's obviously mechanisms where you acknowledge, there needs to be an acknowledgement and notification to the super fund that you do want to claim a tax deduction for that. So that, and they all need to be done before you lodge your tax return. So there's a little bit of time to do that. You can notify the super fund afterwards, but the contribution has to be in. And with the non-concessional caps, there's plenty of other things in relation to super, but in terms of tax planning, the main thing is that obviously with a non-concessional cap, that's gone. There's no sort of catch-up contribution. So if you are looking at making a contribution, you can obviously bring forward contributions for future years, but you can't catch up on non-concessional ones. So if you want to make use of that, although you don't get a tax deduction for it, but if you're looking at getting extra money into super, then they need to be done by 30th of June.
So we're up to questions. Happy to take questions, whether they be verbal or typed up in the chat. We've got about five or so minutes to deal with any questions that anyone might have. Otherwise, Jeet's going to sing and dance for us while we wait.
You definitely do not want that. Yeah, no, if no one has any questions, just yeah. So obviously we've had to go through it reasonably quickly in terms of with the time span, but this is just a reminder to things that you need to consider, and we like to do it early so that you've got a couple of months to consider this. Get in contact with your contact, as Tass has put up on there. With just get in contact with a partner or manager or accountant that you deal with. And they'll be able to answer your questions for you.
Look, look, we're all probably going to be going through the process of dealing with each client individually, because everyone's tax situation is different. So there's different business requirements, there's different taxes that we need to sort of deal with and address, and commercial issues that we need to sort of take into consideration. So it's very difficult to I suppose we're just basically highlighting what things need to be looked at before 30 June, but obviously when we talk to you individually, they'll be tailored to your specific needs. If there's nothing else, we'll stop the presentation here. We thank you for joining us. And look forward to seeing you at the next presentation, which I think has got to do with, we're trying to line up someone to talk to us about what rising interest rates will mean for your investments and stuff like that. So when when we can pin down the presenter and have a date for you, we'll sure to be emailing everyone. Thanks on behalf of me, Jeed. Final words before we wrap up.
Yeah, no, just yeah, thank you everyone for attending, and yeah, just get in contact. Any questions? The slides, we should be sending the slides out. So yeah, so if you didn't have a chance, obviously, to get any notes down, or just contact us and we can get them to you.
Thanks everyone.
Thank you.